When people do gold in constant dollar terms, we would probably need 2750 or 28 to have a real breakout. I think because the investment community has a memory of the performance of the gold stocks in the decade 2000 to 2010, which was pitiful. The gold price moved, if my memory serves me correctly, from about $2,500 to about $1,800, which is to say a sevenfold increase in the gold price. And the free cash flow per share on the XAU fell. It took skill to turn a sevenfold increase in the selling price of your commodity into reduced cash flow per share. So the expectation around the gold stocks, not merely in the general investment sector, but specifically among gold investors, is a terrible pun, but tarnished.
Gold serves as a natural hedge against inflation and is widely regarded as a safe haven investment during economic downturns. For investors, gold stocks play a crucial role in asset allocation, particularly during periods of high inflation and economic uncertainty. Currently, gold is trading above $2,500 per ounce, marking a new record. Yet despite this, gold stocks remain subdued, leaving many to wonder why. Rick Rule believes that in constant dollar terms, we would likely need to see gold reach $2,750 or $2,800 to achieve a real breakout. He notes that the investment community still remembers the poor performance of gold stocks during the decade from 2000 to 2010. Despite the gold price rising from around $250 to about $1,800, a sevenfold increase, the free cash flow per share of the XAU index actually fell. With the demand for gold pushing higher, it could spill over into gold mining stocks. Notable gold bull Peter Schiff was effusive in his praise for gold mining stocks. Schiff noted on X that precious metal mining could be one of the prime sectors offering the best gains for the next 10 years. The tweet reads, "Gold just had 2 consecutive daily closes above $2,500. Many gold mining stocks hit new 52-week highs today. The stage is set for a major bull market. I expect precious metals mining to be the best performing sector, not just for the remainder of this year, but for this decade." Investors, according to Rule, need to evaluate what they are trying to achieve. In a genuine gold bull market, which he believes we may be in the early stages of, the market beta, meaning how much gold stocks outpace the broader market, can be substantial. For older investors, like himself at 71 years of age, Rule suggests constructing a portfolio of the 5 or 6 best gold mining companies in the world to participate in this beta while minimizing operating risk. Let's jump into the video for more details. If you like what you see, please thumbs up and subscribe to our channel to stay updated with our latest content.
Bull markets traditionally follow a fairly consistent path, which is to say in commodities, the commodity moves first, and then the biggest, most efficient producers who can turn that commodity price increase into margin increase moves second. The move in the gold stocks has been constrained, I think, because the investment community has a memory of the performance of the gold stocks in the decade 2000 to 2010, which was pitiful. The gold price moved, if my memory serves me correctly, from about $2,500 to about $1,800, which is to say a sevenfold increase in the gold price, and the free cash flow per share on the XAU fell. It took skill to turn a sevenfold increase in the selling price of your commodity into reduced cash flow per share. So the expectation around the gold stocks, not merely in the general investment sector, but specifically among gold investors, is a terrible pun, but tarnished. What I think people are missing is that institutional investors in particular and sector investors are holding the managements to much higher standards now. And I suspect for the next 2 or 3 years, at least, that there will be much more fiscal discipline in the sector than there was. You mentioned Agnico Eagle as a bellwether, as a leader. That's because they've been a leader in the deployment of capital for 15 years. It's because they have been leaders in constraining their all-in sustaining capital costs. They've been leaders in selling off marginal assets and upgrading the quality of their portfolio. They haven't been a leader just because the gold price went up. They've been leaders because they've outperformed other companies in the sector. Investors, too, need to look at themselves, what they're trying to accomplish. My own experience has been that when you have a genuine gold bull market, which I think, but don't know, that we're in the early stages of, that the market beta, which is to say, in my definition, the extent to which the gold stocks themselves outpace the broad market, is substantial. And some investors ones of my age, as an example, 71 years of age, might do well to try to construct a portfolio of the 5 or 6 best gold mining companies in the world. In other words, participate in the beta that you might otherwise get with an ETF, but buy the higher quality companies so that you excise operating risk from your portfolio. For those who are, pardon me, Jesse, for those who are seeking alpha, of course, you need to come down the quality trail. You need to come down to the single asset producers that will be consolidated or taken over by multi-asset producers with a lower cost of capital. You may come all the way down into exploration, which has treated me well, but exposes you to a lot of risk outside the gold price. But I think it's important that one of the things that your listeners do, Jesse, is that they assess themselves. They assess how much work they want to put into investing. They assess how much risk they want to take, and they adjust their time preference to reality. You probably know that I have now graded over 80,000 portfolios for investors in the last 6 years, and I've learned a lot about the mistakes that investors make.
As we advance through 2024, silver's relative underperformance against gold, coupled with rising industrial demand and favorable economic conditions, underpins its long-term potential. Silver continues its upward momentum, breaking $30.1 with strong demand. The next target is $30.62, with dynamic resistance approaching near the 78.6% Fibonacci level. Our long-standing projection has been that silver will eventually hit $50 per ounce. Rule advises silver investors to recognize that silver generally lags behind gold in a bull market. Based on his experience, silver tends to lead only when generalist investors start buying into the precious metals narrative, which typically happens later in the bull market cycle. Let's now turn our attention to the video again.
So I think it's important to understand the risk. The bigger risk in the silver miners is that too many of the junior silver miners don't have any economic silver. That's a much bigger risk. Governments don't steal something that isn't worth stealing. So you should substitute political risk for technical risk. You want grade and you want size. It is true you have greater optionality in a silver bull market with the, quote, bullshit silver mines, the people who have great narrative, tiny market caps, and can promote well in a liar's market. But there's too much risk assuming that somebody even dumber than you is buying a burning match after you buy it in a bull market. So you want the higher quality names. And the higher quality names aren't markedly more expensive, or frankly, are often less expensive on a net present value than the more speculative ones. Want silver? Look at MAG, a big silver producer. Way too much G&A. Way too much G&A. All they really have to do is audit their partner, Fresnillo, and they pay themselves very, very well for doing that. Meanwhile, world-class ore body. I'm attracted to the discoveries made by Vizsla Silver. I'm attracted to the discovery made by Abra Silver. I'm attracted, although it is expensive, to the superb operating performance of Aya Silver. I mean, these guys have just knocked the ball out of the park operationally. I'm impressed, too, with the operating performance of Silvercrest, although I need to see a new reserve and resource statement to increase my confidence about the fact that this is a long enough lived ore body to give me the net present value that I'm hoping for. Silver investors need to understand that silver generally lags gold in a bull market, depending on how far the way through the bull market we are. My experience has been that when the generalist investor buys into the precious metals narrative, that's when silver leads. Until then, when it's still a fear market, gold leads. The point of all this is don't, again, buy into the silver market with a short-term narrative. It's not a short-term trade. The spark hasn't been lit underneath silver or silver stocks. You do it with uncertain timing because the rewards for success are so incredible. As Doug Casey points out, when the generalist investor comes into the silver space, the market capitalizations of the legitimate silver juniors are so small that, as Doug says, the result is like trying to siphon Hoover Dam through a garden hose. There is not enough room in the sector to handle the money. And the returns are berserk. I probably now have 2.5% of my portfolio in the silver equity space. And it wouldn't surprise me to see that 2.5% of my portfolio become 25% of my portfolio. I'm not saying it's going to, but that's what tends to happen when you come into a silver bull market. And if we do come into a silver bull market, Jesse, I hope that you're leading the bandwagon with your listeners to tell them to sell some. You haven't made the money until you've taken the money. And if you're one of those people for whom the narrative gets more valuable as the price goes up, you will be a victim.
With gold at a record high and margins improving to their former level, we have every reason to think gold shares will break out above this old 2020 high. Could it happen in the coming year? But let's add to that impending rate cuts from the U.S. Federal Reserve, the first cut expected next month. That could give gold an extra boost. Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.